You're watching Silver News Daily. Subscribe for more. Imagine turning your investment into a gold mine as silver skyrockets to $2,500. Sounds impossible? Well, today we have Rick Rule, one of the foremost experts in precious metals, breaking down exactly why this could happen sooner than you think. Stay tuned as we uncover the critical factors driving this potential surge and learn how you can position yourself to benefit from this incredible opportunity. Trust me, you don't want to miss this.
That reduction in theft has to do with the fact that oil and gas assets are finite. If you and I owned a bakery, Dunnigan, bricks and mortar and steel and stuff like that, we could take flour and salt and water and sugar and butter in the front door and kick bread out the back door for 100 years. There wouldn't be any depletion. In the oil and gas business, if we drilled a well, after 10 years, we wouldn't have any income left. So in the case of both oil and gas and mining, the income is taxed differently. It's viewed as being a depleting asset. Very much, by the way consumer products companies are allowed to expense advertising, not expense advertising, but in fact write off advertising. The useful life of a customer that Heinz Kraft develops through their television advertising may be 15 years, but they're allowed to expense that customer acquisition via advertising in year one. So the oil and gas industry is subsidized the same way that the grocery industry or the movie industry or the television industry or the retail industry is subsidized, which is to say government agrees to steal less from them. That's the subsidy. Unlike the subsidies that, say, the electric vehicle manufacturer enjoys, where the government outright gives them $5 billion to build a plant and then subsidizes the consumer purchase of their output by $12,000 a vehicle, and then in addition to that, pays them to train workers. Those are subsidies. What the government does for Exxon is steal less. What the government does for Tesla or SpaceX is give them more. Those are very, very different discussions.
I think a lot of our viewers would like to be stolen less from. Think for yourself. 8258 says, what is Rick's view of deep sea mining?
I'd hate to pay the pumping costs. Deep sea mining probably becomes a thing 20 years from now in a limited scope and scale. There are wonderful, what are called nodules, precipitated collections of metal by submarine volcanogenic vents, where minerals in concentration come out of the Earth's crust and condense when they hit seawater, forming nodules that are frequently manganese, copper, nickel, cobalt rich. The difficulty with them, of course, is that you have to mine them robotically. And the technology to really do that, advanced robotic dredge technology, is early on.
Before we get into the details, let's talk about Rick Rule. If you're not familiar with him, Rick Rule is a renowned investor and expert in the field of natural resources. With decades of experience, he has a deep understanding of precious metals markets and has successfully navigated countless economic cycles. His insights are highly sought after, and today, we're fortunate to hear his take on why silver might just be the best investment you can make right now. So who is Rick Rule, and why should you listen to him? Well, Rick has been at the forefront of resource investing for years, founding Rule Investment Media and previously leading Sprott Asset Management. His track record speaks volumes, and his predictions are backed by extensive research and a deep knowledge of market dynamics.
Derivatives, and Bank of America only has $42 trillion in derivatives. You would have to know about every individual derivative contract. Is there a mismatch in duration? Derivatives are sold over the counter. And so, as Warren Buffett points out, you have two rocket scientists, one at Citicorp and one at JP Morgan Chase. They sign a 15-year contract, and both of them assign a net present value profit to the transaction for bonus purposes. If there's a mismatch in duration, say 5 years on one side and 15 years on the other, they assign the net present value arbitrarily. So I am not capable myself at assigning a risking to the entire derivatives book at these big banks. Remember that the banks will tell you that the notional value of the derivative, the notional pricing of the derivative, is very different than the real price because the derivatives exposure has been hedged. That's true as long as both parties pay. But if one party doesn't pay, then that portfolio becomes decidedly unhedged. I think a different problem that bank investors and bank depositors and borrowers need to face is the duration risk. You have a lot of banks where if they were required to mark their asset base to market, particularly their long-term bonds, their mortgage bonds of greater than 7-year duration, that mark to market would wipe out the bank's entire capital. The banks are allowed to hold those assets on the books as being held to maturity and ignore the market price of those assets. In other words, they are encouraged by the government to perpetrate securities fraud. And if you ask your bank for a statement of financial condition, which they are obliged to give you, you can look in portfolio composition at that percentage of their assets which are closed, quote, held to maturity, and determine without too much effort what concentration risk your bank employs. I can tell you, Dunnigan, at Battle Bank, our duration risk will be nil, which is to say that we will not fund long-dated fixed rate assets, loans, with overnight deposits. That's what brought down the U.S. savings and loan industry. It's what brought down Sovereign Bank. It's what brought down Silicon Valley Bank. The temptation that these guys have to chase 11 or 12 basis points in yield by going out 8 years on the duration curve and funding that with overnight deposits.
Let's dive into the current trends in the silver market. As of today, silver is trading at $30.59 per troy ounce, up 0.95% from yesterday. This is part of a broader upward trend we've seen this year, with silver prices increasing by an impressive 28.55% since the beginning of the year. But what's driving this surge? Several factors are at play. Firstly, there's the economic uncertainty. Historically, silver, like gold, is considered a safe haven asset. When markets are volatile and currencies are unstable, investors flock to precious metals to protect their wealth. Secondly, we have the industrial demand. Silver isn't just a pretty metal, it's a vital component in many industrial applications. From electronics to solar panels, the demand for silver in industrial settings is soaring. In fact, industrial applications now account for roughly half of the annual demand for silver. This year alone, the demand for silver in the green economy, especially in solar photovoltaic panels, is forecasted to rise by another 4%, hitting a new record high. Furthermore, the banking crisis in the U.S. has also played a role in boosting silver prices. As investors look for stability, precious metals become more attractive. The expectation of interest rate cuts in the latter half of the year is also providing support to silver prices. As gold prices run up, silver becomes relatively more attractive, drawing more investors in. With these strong trends and supportive economic factors, it's no wonder experts are bullish on silver. And as we'll explore further, Rick Rule's analysis shows why silver's rise to $2,500 might be closer than we think.
Larger companies command larger market capitalizations, more trading volume, which means higher share price, lower cost of capital. In a capital-intensive business, a lower cost of capital is a decided competitive advantage. The second thing is, from an institutional investor's perspective, more scale means lower general and administrative expense relative to assets under management. And in the case of producing companies like Remelius, G&A as a lower percentage of EBIT or free cash flow. Finally, having more assets in the company stable allows the management team to optimize the deployment of capital over a larger asset base rather than focusing their capital on one asset that might preserve their salary. The consequence of that is that mergers and acquisitions broadly, if they're well constructed, are a good thing. And we're early enough in the process that the benefits of mergers and acquisitions outweigh the costs. And I think you'll see them continue. And
to understand silver's potential, it's crucial to look at its historical performance, especially in comparison to other investment assets like gold and the Nifty 50 index. Over the past 5 years, silver has delivered returns of 13.1%, slightly outpacing gold's 13% and the Nifty 50's 12.3%. This is notable because silver is often viewed as the poor cousin of gold, yet it has shown impressive resilience and growth. In the last 3 years, silver has outperformed gold significantly, delivering returns of 20.8% compared to gold's 8%. However, it trailed behind the Nifty 50, which saw returns of 23.8%. One of the key reasons for silver's impressive performance is its volatility. While this can lead to periods of underperformance, it also means that silver has the potential for significant gains during bull markets. For example, during the economic turmoil of the past few years, silver's demand surged, driven by its dual role as both an industrial metal and a safe haven asset. Moreover, when we compare silver's performance to gold using the gold/silver ratio, which currently stands at 80.64, we see that silver is undervalued relative to gold. Historically, this ratio has been much lower, suggesting that silver has significant room to grow to realign with its historical norms. Silver's utility in industrial applications further supports its growth potential, as industries like electronics, renewable energy, and 5G infrastructure continue to expand. The demand for silver is expected to rise, providing a strong foundation for its price increases. So when we examine silver's historical performance and compare it to other assets, it becomes clear that silver not only holds its own, but also has the potential to outperform, particularly in volatile economic climates. And with current market trends, silver's future looks brighter than ever.
For most investors, ExxonMobil is the place that you start a natural resource investment portfolio. It's a large cap company that is extraordinarily well run and is cheap. They have historic high returns on capital employed. They've been historically very good capital allocators. In today's market, where the oil industry, as a whole, is underinvesting in sustaining capital investments to the tune of $1 billion a day, Exxon is stepping up the pace of sustaining capital investments and doubling up by spending $60 billion on Pioneer, which is to say, as big a producer as they are now, they'll be a bigger producer 3 years from now, when most of their competitors will be smaller producers. In addition to that, Exxon has made a series of discoveries in Guyana totaling about 11 billion barrels. The idea that they've had an exploration success that's big enough to move the dial at Exxon is incredible, but that's what they did. While developing an 11 billion barrel discovery, while spending $60 billion to buy Pioneer, and while increasing their level of sustaining capital investments, they have decided that this year they will increase returns to shareholders via buybacks and dividends by 14%. There are very few companies in the world, if any, that have both the ability and the will to do all.
One of the most compelling reasons for silver's bullish outlook is its growing industrial demand. Unlike gold, which is primarily used for investment in jewelry, silver has extensive industrial applications that are integral to modern technology and green energy solutions. In the electronics sector, silver's superior conductivity makes it a critical component in various devices, from smartphones to computers. The ongoing growth in consumer electronics continues to drive up the demand for silver. Additionally, the expansion of 5G infrastructure is another significant factor. As the world moves towards faster and more reliable internet, the need for silver in 5G technology is expected to rise substantially. Perhaps the most exciting driver of industrial demand for silver is its role in the green economy. Silver is a key material in the production of solar photovoltaic (PV) panels. As the world increasingly turns to renewable energy sources to combat climate change, the demand for solar panels, and consequently silver, is set to soar. In 2023 alone, the use of silver in solar panels reached an all-time high, and this trend is projected to continue, with green economy-related industrial demand forecasted to rise by another 4% this year. Moreover, China's economic recovery post-COVID is expected to bolster silver demand further. As Chinese industries ramp up production and consumer spending starts to stabilize, the need for industrial silver is likely to grow. These industrial applications are not just temporary trends, they represent a structural shift in how silver is utilized globally. This growing industrial demand provides a strong and steady foundation for silver prices, making it a compelling investment. Rick Rule emphasizes that this unique combination of silver's role as a safe haven asset and its critical industrial applications creates a perfect storm for significant price increases. As industries continue to innovate and expand, silver's importance and its price are poised to rise.
Very large shareholding in Ivanhoe Mines, a material shareholding. I'm delighted to say that my average cost is substantially below $1. And I've taken enough out of the trade that I have no net exposure to the company. Now on to the question. Kipushi will be at nameplate capacity in terms of production in about 9 months. It is the highest grade zinc mine in the world by a substantial margin. There is, of course, political risk because it, like Kamoa-Kakula, is in Congo. Congo's a frontier market, make no mistake. Unlike Kamoa-Kakula, at Kamoa-Kakula, Ivanhoe's partner is effectively parastatals controlled by the government of China, so that China is their protector. At Kipushi, Ivanhoe has no such advantages. I would expect things to go well at Kipushi, and I would expect Kipushi to generate really substantial, really surprising free cash flow for Ivanhoe, particularly given the completion of the new rail facility from Katanga, the so-called Libido Corridor rail corridor, which means that Ivanhoe can now ship both copper and zinc concentrates by rail as opposed to by truck. I think that'll make a huge difference. The Platte Reef is a much different discussion. The Platte Reef is the largest undeveloped concentration of high-grade precious metals on the planet, particularly platinum and palladium. Platinum and palladium have decreased in price by 50% in the last 18 months. Because of that, I like platinum and palladium, and I like the byproduct, nickel. This will be a major capital expenditure. It's important to note that 10% of the deposit is owned by
Global economic conditions play a pivotal role in the performance of precious metals, and silver is no exception. In recent times, several economic factors have created a favorable environment for silver prices to rise. Firstly, let's talk about economic uncertainty. The world has seen significant economic turmoil, from the COVID-19 pandemic to geopolitical tensions and recent banking crises. During such periods, investors seek safe haven assets to protect their wealth, and silver is a traditional choice. Its role as a hedge against economic instability and inflation cannot be overstated. As inflation continues to be a concern, the appeal of silver as a store of value grows stronger. The banking crisis in the U.S. has further boosted silver's attractiveness. With banks facing unprecedented challenges, there's a ripple effect on global financial conditions. Investors are moving away from traditional financial assets and seeking refuge in precious metals. Silver, often seen as a more affordable alternative to gold, becomes especially appealing. Interest rate policies also have a direct impact on silver prices. As markets anticipate rate cuts in the latter half of the year, the lower interest rates make non-yielding assets like silver more attractive. This is because the opportunity cost of holding silver decreases when interest rates are low. Furthermore, the correlation between gold and silver prices plays a crucial role. When gold prices increase, silver often follows, but with more volatility. This makes silver a high beta version of gold. With gold prices already on an upward trajectory, silver is likely to experience an even greater surge as investors look for higher returns. Rick Rule points out that the confluence of these global economic factors creates a perfect environment for silver to thrive. The combination of economic uncertainty, favorable interest rate policies, and the ongoing demand for precious metals as safe havens sets the stage for silver's potential explosive growth. Understanding these global economic factors is key to appreciating why silver is becoming such an important part of any investment portfolio today. As we move forward, these conditions are likely to continue supporting silver prices, driving them to new heights.
The type of portfolio one has, as an example, a 65 to 70-year-old retired person with a lot of time left on Earth, whose portfolio is 75 or 80% in long-term bonds, needs to own a bunch of gold. Inflation murders a portfolio like that. They will get the bond yields, but the bond yields will buy less and less and less and less and less. An investor who has a reasonably leveraged real estate portfolio, reasonably, not unreasonably, who's a decent real estate operator, who benefits from inflation, because the ability of competitors in real estate to construct new product in inflationary times to compete with his existing product is low. So that person would need to own less gold. So while I know that everybody wants a one-size-fits-all answer, there isn't one. It depends on the needs of the individual, and it depends on the composition of their existing portfolio. I have much more physical gold in my portfolio than a financial planner would tell me that I needed. As an example, because I'm the largest shareholder of Sprott, one would expect that as the gold price increases, the assets under management at Sprott would increase and the management fees at Sprott would increase. And probably the popularity of Sprott in an increasing gold price environment would increase. So I would benefit from an increase in the gold price, whether or not I owned gold. But I own gold as an insurance asset. It helps me sleep nights and stay calm. And at 71 years old, 1 year of age, sleep is a very nice thing. I don't own gold because I think it might go from $2,400 to $2,700. I own gold because I'm afraid it'll go to $9,000 or $10,000. Somebody who has less fear than me.
Now that we've explored the strong fundamentals driving silver prices, let's look at how you can capitalize on this opportunity through mining stocks. Investing in mining stocks offers exposure to the silver market and can amplify your returns, given the leverage these companies have to the underlying metal prices. Precious metal miners are companies that primarily extract high-value metals like gold and silver. They often attract investors during times of economic uncertainty as a hedge against inflation. Examples include Barrick Gold and Newmont. Investing in silver miners such as First Majestic Silver or Pan American Silver allows you to benefit directly from rising silver prices. Junior miners are smaller, exploration-focused companies. They carry higher risk but also offer higher reward potential. Junior miners often have significant growth prospects if they make a substantial discovery. For instance, companies like Silvercrest Metals are known for their exploration activities and potential to find new silver deposits. Diversified miners produce a variety of minerals and metals, providing a buffer against the volatility of any single commodity. Firms like Glencore and Anglo American operate mines that produce silver alongside other metals, such as copper and zinc. If you prefer a diversified approach, you can invest in exchange-traded funds, ETFs, that focus on silver miners. ETFs like the Global X Silver Miners ETF, sister-in-law, give you exposure to a broad range of silver mining companies, reducing the risk associated with investing in a single stock. Additionally, there are funds of funds that invest in multiple silver ETFs, providing even broader diversification. Rick Rule emphasizes the importance of investing in high-quality mining stocks with strong management teams and sound financials. He advises looking for companies with low production costs, robust reserves, and strategic locations. Moreover, consider the geopolitical stability of the regions where these companies operate. Political risks can significantly impact mining operations, and it's crucial to invest in companies with operations in mining-friendly jurisdictions. To get started, you'll need to open a share dealing account and conduct thorough research on the best mining stocks for your portfolio. Platforms like TD Ameritrade, Fidelity, and E*TR80 offer tools to help you research and invest in these stocks. By investing in mining stocks, you can potentially achieve higher returns than by investing in physical silver alone. These stocks can provide regular income through dividends and benefit from operational efficiencies and exploration successes. As Rick Rule has shown, mining stocks are a powerful way to leverage the booming silver market. With the right research and strategic investments, you can position yourself to benefit from the anticipated rise in silver prices.
I think part of that has to do with management incentive. Both sets of managers would prefer to be the survivor, but there can only be one survivor. And particularly management teams that aren't large shareholders, but draw good salaries and emoluments, are merger averse because it kicks them off the gravy train. I think that's the primary disincentive. What I think you're going to see happen in the next 2 or 3 years is that institutional investors will force mergers and acquisitions because the benefits in terms of higher share prices and hence lower cost of capital and lower G&A are so overwhelming that recalcitrant managers are catching us with regards to mining policy. Political risk is a given, unfortunately. In mining, your assets are fixed. If the questioner and I owned a freighter and one port became unfriendly, we'd sail out of the port and never go back there. Unfortunately, a mine in Western Australia is in Western Australia. Even worse, a mine in California is in California. You must assume the worst and hope for the best. What I try to do is benchmark jurisdictions in terms of their current larceny and greed, and in terms of what other sources of revenue are available to them more easily. But mercifully, in Australia, you have first of all, an economy that's unusually dependent on extractive industries. So there's only a certain level of stupidity that the government can afford. The mining industry is irrelevant in the United States, so the level of stupidity that we can afford here is much greater. Secondly, the sophistication of the Australian citizenry with regards to mining, whether they're employees or relatives of employees in Australia, is much higher. So that the electorate is more likely to spot stupidity in Australia than the U.S. electorate, who unfortunately would often be challenged to spell.
To further solidify our understanding of silver's potential, let's delve into expert opinions and predictions. Rick Rule, a highly respected voice in the investment community, believes that silver's future is incredibly bright. He has highlighted several key factors that could drive silver prices to unprecedented heights. Rick Rule points out that the current economic environment is highly conducive to a silver price surge. The combination of economic instability, inflationary pressures, and rising industrial demand creates a perfect storm for silver. He emphasizes that silver is not just a precious metal, but also a critical industrial commodity, making it uniquely positioned to benefit from multiple market dynamics. Several other industry experts share this optimistic outlook. The Silver Institute, for example, forecasts that global silver demand will reach near record levels, driven by industrial applications and investment demand. This sustained demand, coupled with supply constraints, supports a bullish case for silver. Investment analysts are also projecting significant price increases. Some predict that silver could reach $50 per ounce in the near future, while more aggressive forecasts suggest prices could skyrocket to $100 per ounce and beyond. These predictions are based on historical patterns, current market trends, and future demand projections. A key factor supporting these predictions is the gold/silver ratio. Historically, when this ratio is high, silver tends to outperform gold as it reverts to its mean. Currently, the ratio suggests that silver is undervalued relative to gold, indicating substantial upside potential. Rick Rule also stresses the importance of silver's role in the green economy. With the global push towards renewable energy and technological advancements, silver's use in solar panels and electronics is expected to rise significantly. This growing industrial demand is a critical driver of silver prices. Moreover, the expectation of interest rate cuts by central banks globally is another factor that could boost silver prices. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, making it more attractive to investors. In summary, the convergence of expert opinions and market predictions paints a highly optimistic picture for silver. Rick Rule's insights, backed by data and historical trends, suggest that silver has the potential to reach unprecedented levels. As an investor, understanding these expert perspectives can help you make informed decisions and position yourself to benefit from the anticipated rise in silver prices.
Silver is always a byproduct of copper production, and so the amount of revenue available from a silver stream relative to copper production means that it's not in the company's interest to do that. In fact, What tends to happen is sort of the other way around, albeit not involving governments. What often happens is a copper producer with byproduct silver pre-sells the silver production to a streamer in return for a disproportionate share of the capital cost of putting the mine in production. The governments are much more inclined to steal than to trade. So what I think you'll see in the case of the copper business is de facto nationalization. Rather than stealing the mine outright, you will see them increase the requirement for offsite capital contributions, like building schools, roads, and water systems, increasing taxation, increasing duties, and increasing royalties. Stealing the output, very much like the U.S. government stole the oil and gas industry's output, matters because it doesn't take into account utility. Prices move really as a function of utility. Silver has two utilities. One, which is highly speculative as a medium of exchange and a store of value, which is to say its investment characteristics. The other is its industrial utility, its use as a germicide, and its use as a reflectant in solar applications. So while I understand the first part of the question, I think the attention that silver adherents pay to the 16-to-1 relationship between the relative abundance of gold and silver in the Earth's crust is probably less important than the social roles that they've both played in terms of investment demand or the industrial.
Now that we covered the expert predictions, let's explore some practical strategies to invest in silver and capitalize on its potential growth. There are several approaches you can take to add silver to your investment portfolio, each with its own benefits and considerations. One straightforward way to invest in silver is by purchasing physical silver. This includes buying silver coins, bars, or bullion. Physical silver offers the advantage of being a tangible asset that you can hold in your hand. It serves as a hedge against economic uncertainty and can be a store of value in times of market volatility. However, storing and insuring physical silver can be cumbersome and involve additional costs. Another effective strategy is to invest in silver exchange-traded funds, ETFs. ETFs like the iShares Silver Trust, SLV, or the Global X Silver Miners ETF, sister-in-law, provide exposure to the silver market without the need to handle physical silver. These funds track the price of silver or a basket of silver mining stocks, offering a convenient and liquid way to invest in silver. ETFs also allow for easy diversification within the silver sector. For those interested in higher potential returns, investing in silver mining stocks is an attractive option. As discussed earlier, mining stocks offer leveraged exposure to silver prices, meaning they can provide significant gains if silver prices rise. It's important to choose mining companies with strong fundamentals, such as low production costs, substantial reserves, and experienced management teams. Companies like First Majestic Silver and Pan American Silver are notable examples. If you prefer a diversified approach, consider mutual funds or hedge funds that focus on precious metals. These funds are managed by professionals who actively select and manage a portfolio of mining stocks, ETFs, and other silver-related assets. This approach can reduce risk by spreading investments across multiple companies and assets. Another innovative way to invest in silver is through silver-backed IRAs. These retirement accounts allow you to include physical silver or silver-related assets as part of your retirement savings. Companies like Goldco offer silver IRAs, providing tax advantages and a way to diversify your retirement portfolio with precious metals. For investors who want exposure to silver without directly buying the metal or mining stocks, silver futures and options can be a viable option. These financial derivatives allow you to speculate on the future price of silver, offering the potential for high returns. However, they also come with higher risk and complexity, so they are best suited for experienced investors. Rick Rule advises diversifying your investments to balance risk and reward. By combining different investment vehicles like physical silver, ETFs, mining stocks, and silver-backed IRAs, you can create a robust portfolio that capitalizes on silver's potential while managing risk. As silver prices continue to rise, having a well-thought-out investment strategy will help you maximize returns and achieve your financial goals. Whether you are a seasoned investor or just starting, understanding the various ways to invest in silver will position you to benefit from its promising future.
The government of Japan So one might expect that the Japanese government would exert some form of diplomatic pressure on the government of South Africa not to steal. We'll see how successful that is. A major capital expenditure in South Africa without the new mining code is challenging. This is an unbelievable deposit. If Ivanhoe can find a way to craft an intelligent fiscal stability agreement with the South Africans and hold the South Africans' feet to the fire with regards to what they're able or intend to steal, this will be a stupendously profitable asset, one with a current mine life well in excess of 40 years. But there are obviously political risks. The recent election in South Africa had no successful conclusion. The African National Congress, which is to say the incumbents, attempted to fashion a coalition with the Democratic Alliance, which is a much better alternative for South Africa. It looks as though they have been unsuccessful in dividing the spoils in terms of cabinet with the DA. And now they are looking at fashioning alliance with MK, an overtly communist party, and the economic freedom fighters who advocate the nationalization of every economic interest in South Africa, and sing a song called Kill the Boer, which advocates the murder of white South African farmers. So when somebody is considering a $1 billion plus investment in South Africa, you need to take into account the current and past political and social reality of the country.
With all the information we covered, it's clear that silver is poised for a significant breakout. Let's bring everything together and understand why silver could reach $2,500 and become a cornerstone of any investment portfolio. Firstly, the economic fundamentals are strong. Silver's price has been steadily climbing, reflecting its status as both a safe haven and an essential industrial metal. The current price of $30.59 per troy ounce, up 28.55% since the beginning of the year, is just the beginning. Economic uncertainty, inflation fears, and market volatility drive investors towards precious metals, and silver stands out due to its affordability and accessibility compared to gold. Secondly, the industrial demand for silver is surging. As we transition towards a greener economy, silver's role in technologies like solar panels, electronics, and 5G infrastructure is becoming more critical. This growing industrial use, accounting for nearly half of silver's annual demand, provides a solid foundation for sustained price increases. Additionally, expert opinions and predictions paint a bullish picture. Rick Rule and other industry leaders emphasize silver's unique position to benefit from both economic and industrial trends. The gold/silver ratio indicates that silver is currently undervalued relative to gold, suggesting significant upside potential. With forecasts predicting silver prices reaching $50, $100, or even higher, the potential for growth is immense. Investment opportunities in silver are diverse and accessible. From physical silver and ETFs to mining stocks and silver-backed IRAs, there are multiple ways to gain exposure to this promising metal. Each investment vehicle offers its own benefits and risks, allowing investors to tailor their strategies according to their risk tolerance and financial goals. The strategic importance of silver in investment portfolios cannot be overstated. Its dual role as a safe haven and an industrial metal provides a unique hedge against economic instability while offering growth potential driven by technological advancements and industrial demand. As global economic conditions remain uncertain and industrial applications for silver expand, the metal's value is likely to continue rising. To sum up, the convergence of economic, industrial, and market factors positions silver as a highly attractive investment. With experts like Rick Rule highlighting its potential, now is the time to consider adding silver to your portfolio. Whether through physical silver, ETFs, mining stocks, or other investment vehicles, you can take advantage of silver's promising future. Remember, investing in silver is not just about chasing high returns. It's also about securing your financial future in uncertain times. So don't miss out on this opportunity. Diversify your portfolio with silver and be prepared for the potential surge to $2,500 and beyond. Subscribe to our channel for more insights and stay updated with the latest trends in precious metals. And always remember, this is not financial advice. Please consult with a financial advisor before making any investment decisions.
But I think the probability of it is low. People have asked me my whole life about the possibility of government confiscations of IRAs, too. The government can steal from you in ways that make them popular. Quantitative easing, which is to say printing more currency unbacked by anything, devalues the currency that you already have in your bank account. That's theft. When governments do it, they're popular. When government increases taxes on some, that's often very popular with the people that they didn't increase taxes on. It's a form of theft that gets them elected. When governments run big deficits like they are today, which is in effect stealing from the unborn or young people, that's popular with the people who are current beneficiaries of that. If you look at Social Security, Dunnigan, our generation, voted itself all kinds of cool benefits, Medicare, Medicaid, Social Security. Yes, we paid into them, but not to the extent that we're going to draw out of them. So the $100 trillion in unfunded, net present value of unfunded liabilities, the benefits that we will generate being paid for by younger people is theft. And 80% of the American population think that theft is more than justified. Given the fact that the government has all these ways to steal from us that are extremely popular, why would they engage in overt theft, which would be unpopular? I was reminded by a congressman, and I won't name him, that Congress is aware of the fact that there are 400 million guns in circulation in the United States. Think of yourself as a congressman. You run the risk, you run the ire of all the gold bugs, many of whom are armed, which is a risk, or you steal from the unborn, which makes you popular, gets you reelected time after time after time. Would you prefer to be loved for being a thief?